everyone! We have arrived at the last month of 2025 and what a year it has been. 2025 has been the most transformative year of my life so far, with several life changes. While some changes are unexpected and difficult to navigate, I remind myself that it's all part of the beauty of life, and I'm optimistic about the year ahead. Enough about me, this video is about investments, and I'm excited to share my TFSA setup for 2026. I made a video in May about my Wealthsimple portfolio, and it was my first long-form video to go a little bit viral. I'm really passionate about Canadian personal finance and financial literacy, so I hope this video also resonates. And very quick recap, the TFSA is a Canadian registered investment account that stands for tax-free savings account and benefits everyone since all withdrawals are completely tax-free. In 2026, the contribution limit is the same as 2025 at $7,000, so all eligible Canadians can contribute $7,000 towards their TFSA between January 1st and December 31st, 2026. I have two TFSA accounts, one in Canadian dollars and one in US dollars. I recently transferred my USD TFSA from RBC to Moomoo, and I keep my Canadian TFSA, of course, with Wealthsimple. This video will focus on my Canadian dollar TFSA, which holds the majority of my TFSA funds. Alright, here's my baby, my Wealthsimple TFSA. I started this account in 2021 and it's been with me through my whole journey since when I first started my corporate job, making questionable investments as a 22-year-old who just started making a full-time income, all the way to today when I'm a more intermediate investor and really turned this account around in 2023-2024 with ETF investments and more stable stocks. And now in December 2025, we're looking at over $51,000 of wealth with over 30% growth all time, meaning nearly $13,000 from this account didn't come from my own money, but rather from the market through capital gains and dividends, which is really the power of investing. And in terms of current portfolio, you can see this year it's up 17% year to date from January until now in December. So it was a really good year, especially with the market run up starting in about May, June, following that major crash in April. And since then, it's just been doing wonderfully. So going through my holdings, I still have some of the individual stock losers like AGN, Good Food. I didn't sell because having that $170 back just doesn't really do much for me, as well as Lightspeed Commerce. But I also made some good investments into utilities like Canadian Natural Resources, Canadian Utilities, as well as LUN for metals. And of course, I have my Harvest ETFs, which pay me monthly dividends. I have EQB, which had a huge run up after I think something happened with PC Financial. There was some news that I think EQB bought something from PC. I'll look into it more. But yeah, it went up like crazy amount in just one day this week on this day. And then I still have, of course, my steady ETFs. So I started investing in these in 2023-2024 era and throughout this year in 2025. Wealthsimple allows you to automate investments, so you don't need to manually go into the app and submit a buy order each time. You just configure the automation once, and then it keeps going until you cancel the order. And this adheres to the dollar cost averaging strategy in investing of consistently investing, steadily investing, regardless of market fluctuations, which removes the emotions out of investing and makes sure that you just stay invested, since timing in the market beats timing the market, or time in the market beats timing the market. Reviewing my most recent TFSA plan for 2025, you can see I lump sum deposited $2,200 at the start of the year in January and invested that money in stable stocks, I believe in Fortis, utilities, as well as some big banks like TD and Scotiabank. And by the way, Scotiabank has been doing exceptional recently, like 40% growth, which is crazy. And then I dollar cost averaged the remaining contribution room, so $4,800 from January 13th to May 30th. And you'll see that here started on this Monday and ended on this Friday. And fun fact, my friend got married on May 30th in Boston. And I remember being in the hotel room about to go to the wedding and then canceling all of my buys on Wealthsimple. And so my strategy here is to invest as much as I can earlier on. Since I had the cash available, I didn't want to drag out the $7,000 until December, so until now, since time in the market is important, right? If you can invest earlier, you should try to do that. But I also didn't want to go to the other extreme of just like depositing and investing $7,000 in January or in January and February in the first 2 months, since I feel like that doesn't really achieve the goal of dollar cost averaging, since the idea is that you continuously buy over a period of time and then you get a good average of all of the prices, high and low. And 2 months or 1 month is just too short of a time frame. And so that's why I struck a balance and chose until May 30th. I feel like that gave me a really good time frame to get an average of all of these prices, but still invest earlier. And this really worked out for me because unknowingly at the time, obviously, but eventually the market crashed in April this year. And so I bought in really low during this time when prices dropped to almost 2023 levels. And so when the market soared from May onwards, so June, July, all the way until December, I really reaped the benefits of getting in at a very low price. And so like I said, of course, I didn't know that it would crash when I made this plan in January or December of last year, but that was a benefit. So as you can see, I invested in multiple ETFs and I made a short on this, which went a little bit viral, but I'll do a quick review here. I made investments into XEQT, VFE, VUN, VXC, XIC, and HTA. Okay, now let's plan for 2026. I've heard feedback that my multi-ETF approach is too complicated and unnecessary, and I know the point of all-inclusive asset allocation ETFs like XEQT is to just buy it and chill, aka just hold the one ETF and keep things super simple, but I do like to buy multiple ETFs to customize my exposure even more. If I were to only buy XEQT, the US exposure is fixed at about 43%, but if I were to buy XEQT and VFE and split my funds between the two, VFE is 100% US market, so obviously my US exposure increases exponentially, which is ultimately what I want. And so I like to choose my own basket portfolio of ETFs so that I can customize my exposure and choose the markets that I actually want. And I also remember from my consulting days, if it ain't broke, don't fix it. Why fix a system that isn't broken and is actually working pretty well? Since a lot of these ETFs have a lot of overlap as well, they're all impacted by a lot of the major trends like the crash in spring and the surge in summer and fall. So I don't really see a huge downside in investing in multiple ETFs versus only one. I'm open to more feedback, but for 2026, I still plan to invest in multiple ETFs, 6 to be exact, which is the same as 2025, to continue my strategy. And so you can see here, I'm going to continue with this bi-weekly alternating basis. This just allows me to invest in 6 ETFs instead of 3. And so this is a Monday. And so Monday, Wednesday, Friday, I will invest in these 3. And then the following week, Monday, Wednesday, Friday, I'll invest in another 3. And then I will alternate bi-weekly. So 6 ETFs total. And this year I'm going to start on January 5th and end on June 26th, which is a Friday. And each time I'm going to invest $66, which is a lucky number in Chinese culture. And this allows all of the sums to basically add up to $4,950. And so I plan to deposit lump sum $2,050 in January 2026. So as soon as the new year comes around, I will deposit this and invest this in some good stocks. And then dollar cost average $4,950 from January until June. So first off, we have XEQT, which is iShares Core Equity ETF Portfolio by BlackRock. It's a well-known, popular, all-in-one ETF that is continuously monitored and automatically rebalanced, so you can really just buy XEQT and chill. The performance in the most recent calendar year 2024 was 25%. And if we scroll down, we can view the geographic breakdown. It's 43% US, 26% Canada, 6% Japan, and the remaining spread mostly across developed markets, but also some emerging markets like China. And second, we have VFE, which is the Vanguard S&P 500 Index ETF. This is the Canadian dollar equivalent of VOO, and it's a popular ETF for Canadians to gain exposure to the US market without having to convert to USD. So VFE is in Canadian dollars. and it tracks the S&P 500 index, so the 503 largest companies in the United States through market capitalization. In the most recent year, it grew 35% in 2024, and the top holdings are no surprise since the US market is very tech heavy. You'll see Nvidia, Apple, Microsoft, Amazon, etc. And third, we have VXC, Vanguard FTSE Global All Cap X Canada Index ETF. So this ETF is a little lesser known than VFV, but it tracks before fees and expenses, developed and emerging markets excluding Canada. So currently tracks FTSE Global All Cap X Canada and China A Inclusion Index. So basically it invests in all cap stocks of companies located in developed and emerging markets excluding Canada. And the most recent year, it grew 26% in 2024. And if we look at the breakdown, it is quite interesting. So scrolling down, we'll see United States of America, US is 65%, Japan 6%, China 3%, UK 3%, Taiwan 2%, France 2%. Also see India, Germany, Switzerland, etc. So it's very diversified globally, but still has majority in the US. So 2/3 US, 1/3 everywhere else except Canada. And then we have XIC, iShares Core S&P TSX Capped Composite Index ETF, which is definitely a mouthful, but basically it's a fund that allows you to own the entire Canadian stock market. It's low cost and designed to be a long-term core holding. And in 2024, it returned 22%, and I believe this will be even better in 2025 since the Canadian market has been performing exceptionally well. We can see a bit of that hockey stick growth at the end of this chart. And scrolling down, we see there are 213 total holdings. And in Canada, our top holdings are the big banks like Royal Bank of Canada, TD, Bank of Montreal, utilities like Canadian Natural Resources and Enbridge, as well as Shopify, which is our tech unicorn. And then we have VA, which is Vanguard's FTSE Developed Asia Pacific All Cap Index ETF. And this replaced VUN for me since VUN, which is the total US market ETF, has a lot of overlap, like 80 to 85% with VFV. And so for 2026, I didn't want to invest in both. I just chose one, VFV, which left space for more global diversification. And I'm really excited to diversify more into Asia Pacific, which I've never had much of in my portfolio. And VA invests in large, mid, and small cap stocks of companies located in developed Asia Pacific markets. It grew 11% in 2024. And if we look at the geographic diversification, it's very interesting. It is primarily the Japan market. So 59% Japan, 17% Australia, 16% Republic of Korea, or 15%, 5% Hong Kong, 3% Singapore, and then a tiny bit in New Zealand and Cayman Island. And last but not least, I definitely wanted an AI and tech-focused ETF in my portfolio, and I chose AIGO, Global X's Artificial Intelligence and Technology Index ETF. This replaced HTA by Harvest for me. Don't get me wrong, I still love HTA, especially the monthly dividends, and I have about $10,000 worth across my accounts. But I wanted an ETF with more AI focus, especially in this era, and AIGO is designed specifically to hold companies positioned to benefit from AI. And this ETF's inception date was May 2024, and since inception, it has grown quite a lot already, 32%. And it's diversified globally, not just in the US. So if we look at the geographic exposure, we have the US at 69%, so majority, but it also has 13% Korea, 4% China, 4% Taiwan, 4% Hong Kong. It's also Japan, Canada, Germany, Ireland, even Israel. And so I like that it's more diversified globally and also positioned to give me more AI exposure through holding AMD, Samsung in Korea, Alphabet, Alibaba in China, etc. So I kept 4 ETFs the same as this year, 2025, XEQT, VFV, VXC, and XIC, and I added 2 new ones, VA and AIGO, which replaced VUN and HTA. All of these ETFs pay dividends as well, usually on a quarterly basis, and their risk ratings are all medium except for AIGO, which is medium high. My first buy order is set for Monday, January 5th, 2026, and I'm excited to see how this year in the market goes. Will we have a huge run up like in 2024 and second half of 2025? Who knows? But this DCA strategy through Wealthsimple's recurring investments feature removes a lot of stress from investing since you don't need to check the market every day and you don't need to react to emotions. You just stay steadily invested. And there you have it. That's my plan for 2026, and I'll keep you updated as the year goes. If you would like to open an account with Wealthsimple and use their amazing features like reoccurring investments, you and I can both get $25 in a win-win situation if you use my referral code to sign up. I'll also leave my code in the description below so you can easily copy-paste. And if you would like to connect with me on LinkedIn, you can find me by searching my full name, Emily Huang, or /Emily S. I'm always happy to connect with interesting people who are passionate about what they do. And of course, thank you so much for watching, and let's manifest a beautiful year in 2026 filled with fulfillment, wealth, health, happiness, and love. Thank you.